We are, in our investment approach, aiming to do really two important things. The first is to deliver strong long-term results, competitive investment returns, and that's really, what you receive in retirement, what drives your balance. So those competitive long-term results are really critical. But the second thing we're doing is achieving that in a way that involves taking less risk. So we want to do that in a smoother way, in a way that smooths out the bumps and bruises. It's about protecting your savings, and it's about giving you confidence in retirement. So we call that the smooth ride, and you've heard that a couple of times, and in things we send you, or if you go onto our website, you might see that term. But really that's what it means, it means strong results, but with less risk. And so why do we do that? That sounds good. You've got a dual purpose, okay, but why? And there's a few points on this slide that really speak to why we would set out to do that on your behalf. It is absolutely the case that the journey to retirement matters, not just the end point. So a journey with less bumps and bruises achieves a better outcome in the long run for you. And we do have a very strong and long track record of achieving these results, so strong returns with less risk. In fact, over 25 years of history of doing so. And it's important because periods where markets actually decline are normal in investing. Those of you who have watched your investments and watched your retirement savings for a long period of time know that there is always inevitably times when things don't go so well in investment markets. And handling those really in the best possible way is critically important. It's important not just because protecting capital means that it's easier to achieve growth along the journey, but avoiding losses is really important for confidence, as I mentioned, about you being really feeling comfortable that your retirement savings are being managed well, because we all worry about the future, and when we see declines in markets, it's harder to make those really good long-term decisions. So you've heard quite a bit about confidence tonight, and that's what the smooth ride really is all about, which is great. Now I'm going to pick up on that point that's the third one on the slide there about the importance of recovering losses quickly. I should just observe that I hope you're enjoying our picture there. I thought that was a very nice, that is sadly not me, but that I think is supposed to be how we want you to feel about your superannuation in a very sort of Zen-like fashion. So thank you for those who helped me with the slides for coming up with that great image. So recovering from losses, a quick point on that. A less Zen slide for you to have a look at. I've got two examples here. They both depict periods of time when share markets fell. The one on the left was after COVID, when inflation started to rise and central banks put up interest rates. And on the left there, if you were a member that started with $100, and if you were in the CareSuper balanced option, which is the dark blue line, your balance would have gone down, and then you would have recovered your balance by January 2023. Now, if you were in the light blue line, which depicts a member in the average fund in the industry, so an average fund experience, you recovered your losses by April 23. That was only a few months later, but that was quite a shallow setback in markets and a very rapid recovery. It is more important when downturns are more protracted or severe. For example, the global financial crisis on the right, again, the dark blue line is the experience of a CareSuper member in the balanced option. After the GFC, members in that option recovered their losses by January 2011. But if you were in the average fund in the industry, you didn't recover your balance, so it was still down until September 2012. That is a year and a half later. That is a long time to be waiting for your balance to recover and start to resume compounding and growing again. So I hope that illustrates the point of the importance of trying to mitigate losses and trying to contain them as much as possible so we can get back to a point of growth as quickly as we can. Now, how do we do that? I've got a couple of slides here that speak a little bit more to the how. Now, we do run a very sophisticated investment program. There is a lot happening under the hood at any point in time. The central feature of our ability to deliver these smooth ride outcomes is really the fact that we're active investors. Everything in our investment program is active, and what that means is that we are agile. We can adjust the portfolio. We like to have a lot of levers that we can work with to achieve certain outcomes, to have more of some investments and less than others at different times. We focus very heavily on careful investment selection. We select everything that we invest in. We don't invest in passive indexes. That allows us to take opportunity, which is value adding a lot of the time, but it also allows us to contain risk. Because delivering the outcomes we're trying to achieve, strong long-term returns with less risk, means that you need to actually avoid some investments. And if you're not active, you can't avoid things that need to be avoided. That really is very important.